Now, I don't know how it is for you, but in any Indian house, the definition of success is very simple. It comes down to a very simple equation. Success equals being a doctor. If you become a doctor, you are by default successful. If you go out and you ask any Indian mom out there, the solution to becoming successful at anything is by becoming a doctor. If you want to make a lot of money, be a doctor. If you want to be happy, be a doctor. If you want to be healthy, be a doctor. You want to get married? Be a doctor. But now, if we dive a little bit deeper and we define what the success is as financial success, now things look a little bit different. Now, I know there's a lot of different definitions of success out there. Being happy, having a good family, being physically healthy, being mentally healthy, having a purpose. But for the purpose of this video, I'm going to be talking about financial success. So now, if the goal is to become financially successful or wealthy or rich or whatever you want to call it, if the goal is to become financially successful, is the solution to become a doctor? Well, becoming a doctor teaches you how to diagnose a sick person, how to take care of a sick person, and how to do a lot of things. If I was sick, I would pay a doctor a lot of money to treat me. But being a doctor doesn't necessarily mean that you're going to be financially successful. Being a doctor means you are qualified to treat other people. At this point, every Indian mom watching this video is saying,
"Oh, Jaspreet's just saying that because he's not smart enough to be a doctor."
And yeah, that might be the case. But if you want financial success, the solution is to be financially educated. Because if you're financially educated, then you have the resources and the knowledge to use your money to become financially successful. This is how the majority of people, probably something like 90% of the population, manage their money. First, you make money from your job. You get a paycheck. This could be $20,000 a year or $2 million a year. It doesn't matter how much money you make. You make money from your job, and the first thing you do is you put this money in your bank account, and then you start spending this money. So you got your home expenses, you got to pay for your car, you got to go buy some clothes, you go on a vacation, you spend some money, and then that's why I got this dotted line here. If there's any money left over, you save this money. Now, some of you might be better than others at saving. You might not spend too much money, that way you can save more money, but for the majority of people, this is how their finances look. You make money, then you spend a lot of it, and if there's anything left over, some of that money gets saved. If you're wondering, "Oh, Jaspreet, how do you know how people manage their money?" Well, just look at the numbers. 1 in 5 Americans do not have $5,000 saved up for retirement, and 7 out of 10 Americans, the majority of Americans, don't have $1,000 in cash saved up to protect them from an emergency. What the minority of people do is they start by smashing that thumbs up button below, because the way the YouTube algorithm works, if you do not smash that thumbs up button, then YouTube is much less likely to show you and other people our financial news and education videos. So if you hit that button, I will very much appreciate it. But what the minority of people do is first, they get paid. So let's assume for this example that you're getting paid from a paycheck again. Now I'm gonna go right to left this time. This time they start by saving money. So you put some money aside for your savings first. And then you invest some money. So you put some money aside, then you put some money to work for you. And after you save and after you invest, that's when you spend. So it's a different order of events. The difference here is the majority of people make money, they spend their money, and then if there's any money left, that's when they save it and that's when they invest it. Wealthy people, the 1%, what they do is you make money and then you save it and you invest it first, and then you only spend what's left after saving and investing, because investing and saving is going to build your wealth. Investing is going to build your wealth even more. Saving is just really protecting your wealth, but you need to do these two things first. That way you can build your wealth. The simplest way to do this is to create a financial system. One of the things you can do is to follow our 75, 15, 10 plan. What that means is for every dollar you earn here, so you make $1 from your paycheck or your business or however you make your money, every time you make a dollar, it's going to flow down in this way. Out of this dollar, 75 cents is the maximum you can spend, 15 cents is the minimum you should invest, and 10 cents is the minimum you should save. When you do this, now you're investing and saving your money and building your wealth first before you spend your money. Now, if you're younger and you don't have a ton of financial responsibilities, then this is your time to build. What you should be doing is following our 50, 30, 20 plan. That means now you're spending less money, you're only spending 50 cents out of every dollar you earn, but you're investing 30 cents and you're saving 20 cents because now this is your opportunity to build. If you don't have a ton of expenses, then invest and save more aggressively now. That way you can build the foundation for your financial wealth. This is where a lot of people put up a smoke screen. They say, oh, you shouldn't worry about money like that. Money doesn't matter. You should just work on being happy. And yeah, you need to be happy, but money is a tool, okay? If you are a good person, money will give you a tool to do more good. If you are a bad person, then money gives you a tool to do more bad. The size of your paycheck matters, but it's not going to determine whether you're going to become wealthy or not. It's what you do with the money you make. Because if you make $200,000 a year and now you're spending $200,000 or you're spending $220,000 with credit cards and loans, well, you're broke. But if you make $30,000 a year and you're saving 10% and you're saving 15%, you are setting yourself up for wealth. But now, in order to build that financial foundation, there's 5 other things that I need you to do. I'm going to be talking about these 5 things. First, you got to track your money. You got to know where every dollar you're earning is going. Then you need to build a financial shield to protect yourself. Then you got to stop bleeding cash. Then you got to put your money to work. That way your money can make you money. And then you got to put fuel on the fire to amplify the system. That way you can build your wealth even faster. First, you got to know where your money is going. Because if you don't know where your money is going, then it is going to disappear. So you need to track how much money you're making and where your money is going. How much money you're spending, where you're spending it, how much you're investing, and how much you're saving. You need to have a track of all of your money. And this is something that you need to do every month. Even if you're not a financial person, you don't like talking about money, this doesn't have to be too hard. There's a ton of free apps out there that you can use to help track your money and help monitor your money. I'm kind of old school. I just use an Excel sheet. I've kind of built my own pro forma and my own kind of system where in the beginning of every month, I write down on my Excel sheet how much money I made and where all my money went, because if you don't know where your money is going, it is going to disappear. In the business world, what we say is if you can't track it, you can't optimize it, because if you don't know how well the system's running, you can't improve that system. Well, it's the exact same with your money. If you don't know where all your money is going, you can't improve where your money is going. You can't improve your wealth because you have nowhere to see how your money is being spent. Once you start writing down where your money is going, the second thing you need to do is build a financial shield, because you need savings. Right now, the vast majority of Americans don't have $1,000 saved up, but the reality is sometimes life happens and emergencies happen and you need cash to cover that emergency, because if you don't have cash, then now you got to go into credit card debt, which is very expensive, or you got to get a payday loan, or you got to get a hard money loan. And in all of these situations, you are getting skinned alive by the lender. And I don't want you to do that, which is why you need to start saving some cash. That way you have a financial shield to protect you from emergencies. In general, your goal should be to save something like 3 to 6 months worth of expenses in your savings account. Now, this savings money is not money that you're going to use for a down payment on a house. It's not money that you're going to use to go buy a nice car. It's not money you're going to use to buy a new cell phone. This money is just sitting there to protect you from an emergency. That way you don't have to go into credit card debt when an emergency happens. So this should be your base goal, 3 to 6 months worth of savings. But if you really want to protect yourself and you want to be really risk adverse, then you should have something like 12 months worth of expenses saved. You don't really want to have too much more than that, because saving money is losing money. Your savings accounts are not paying that much in interest, yet at the same time, inflation is 2 or 3% a year. What that means is the price of things, the price of living is going up by 2 or 3% a year, while your savings are just sitting there flat. So if your savings aren't growing, but the price of everything else around you keeps going up by 2 or 3% a year, that means your savings are essentially losing value each and every day, which is why, yeah, you need savings to protect you. But you don't want to save all your cash, because your goal should be to build your wealth. And I'm going to talk about that in just a second. If you're subscribed to our YouTube channel, you know that I love using my credit card to make transactions, because anytime I use a credit card, I get cash back, I get points, and I never carry any interest because I pay off my entire credit card balance in full every single month. That way I get the perks and the rewards from the credit card company, and I don't pay them any additional money in interest. But a lot of people right now are getting skinned alive by the credit card companies because they're spending money on extra guac that they can't afford. And now you're having to pay 15, 16, 17, 18% interest on that extra guac, which is skinning you alive. And so what you need to do right now is stop bleeding cash. You know, it's always kind of funny to think about this, because we talk a lot about investing on a YouTube channel. And I'll talk about, okay, if you get a 7% return on your money, this is what will happen. Or if you get a 10% return on your money, this is what will happen. And every single time I do that, people will leave comments saying things like, or where am I supposed to get a consistent 10% return? But at the same time, do you want to know somebody who is getting a consistent 19% return every single year? Your credit card company. And you are the one paying it if you have credit card debt. Let me show you what I mean. So I was reading on a NerdWallet article that many Americans are taking more than 10 years to pay off their credit card debt. So if your credit card company is charging you 19% a year, What would happen if you invested that money and got a 19% return on your money? If you could invest $1,000 a month, and let's say you can get a 19% return on your money every single year. Now, I know it's not very easy to get a 19% return every single year, but your credit card company is doing it. So if you invest $1,000 a month and you can get a 19% return on your money every single year, and you do this for 10 years, which is what a lot of people are taking to pay off their credit card debt, this $1,000 a month investment would grow to over $420,000 over those 10 years if you could get the same 19% return on your money. Well, your credit card is getting that 19% return on your money, and so your credit card is becoming wealthy because of you while you are staying broke. So what you need to do right now is you need to stop bleeding cash because you need to pay off your credit card debt as fast as possible. Credit cards are a tool. If you know how to use them and you know how to use your money, you can get a bunch of free perks, you can get a bunch of cash back for doing nothing except making your regular transactions with a credit card. If you don't know how to use a credit card, then you are being skinned alive by your credit card company, and you need to stop bleeding cash and you need to get rid of your credit card until you can figure out how to control your spending. And right now, you need to get out of credit card debt as fast as possible. That means cut your expenses, work harder at your job, get a raise, do whatever you gotta do, find some extra cash and put it towards your credit card debt because you gotta stop bleeding cash as fast as possible because this is eating away at your wealth. Once you get here to number 4, this is where things get really fun because now you're putting money to work. You can only work 10, 12, 14, maybe 16 hours a day consistently. I mean, yeah, maybe some days you can work 20, 22 hours a day, but you can't do that consistently, okay? You're gonna get burned out. But your money doesn't need sleep. Your money doesn't need to go to the bathroom. Your money doesn't need a vacation. Your money can work for you 24 hours a day, 7 days a week, including holidays, which is why once you got this extra cash, you need to put it to work. That way your money can earn you more money because you need your money working for you while you're sleeping. This is what investing is all about. You're sending your money out, that way your money can attract you more money. Lots of people assume that putting your money to work and investing means that you have to throw your money in the stock market, but that's not the only way that you can invest your money, and it depends on what your risk tolerance is. One of the simplest and easiest and the least risky ways to invest your money is just by paying down your debt. If you have student loans that are costing you 6% a year in interest, and you pay it off a year early, well now you just got a 6% guaranteed return on your money for that year, because now you don't have to pay 6% in interest to the bank or your lender. That 6% is what you get to keep in your pocket because you paid off your student loans a year earlier. This doesn't have really any risk because if you pay down your debt early, that's interest that you don't have to pay. You should also be investing in yourself and your own mind because like everybody says, you are your own best investment. If you know how to use your money better, you can use your money better and get a better return on your money. Now, this takes time and it takes money, but this can be one of the most valuable things that you do because if you don't know how to invest your money, then you're not going to be able to get the best returns. So this could mean reading books, it could mean taking classes online, it could mean going to seminars, whatever it is. You need to be investing in your education, especially your financial education, if you want to know how to use your money the right way. That way you can get the best returns on your money. The other kind of education is financial tuition, and financial tuition is when you lose money by making a bad investment. I'm a real estate investor and I have read a ton of books on real estate investing, but some of the best real estate investing knowledge I got was by investing in a property, which I call my nightmare property, where I lost a ton of money. It was my education. It was the financial tuition I had to pay to learn how to be a good real estate investor because there's just some things that you can't learn in books. There's just some things that you can't learn in courses. So that's another kind of education where you just go out and do things because there will be times when you lose money. That's just reality. By the way, if you do want to learn more about my worst real estate deal ever, it was a nightmare property. You know, I read a lot of books that say, you know, every real estate investor has one really bad deal. This is mine. So I want you guys to learn from my mistakes. This is not something to teach you in business books or even something to talk about in real estate books. So I want you guys to learn from my mistakes so you don't make the same mistakes as I did because it was very expensive. Let's take a look inside. I walked through that deal on YouTube, and if you want to watch that video, I will also link it for you in the description below. Then you have investing in assets. This is your more traditional type of investing because now we're talking about investing in the stock market or investing in real estate. Now you're really just putting your money to work. That way your money can attract you more money. The way it works is now you're buying an asset, you're buying an investment for the purpose of making money because you're buying something that you think will go up in value. So if you buy a stock for $100 a share, and then this company starts to make more money and the value of your stock goes to $200 a share, Now you just doubled your money. You can also put your money to work for passive income because now certain stocks pay dividends. What dividends are cash payments is passive income that you get just for owning a stock that pays a dividend. It's the same with real estate. If you buy a home, you can rent out this home for $1,000 a month, and now every single month, your tenants are going to pay you $1,000 a month for living in your property. And now even if you're sitting on a beach somewhere, you're still getting $1,000 a month every single month from your tenants that are living in your property, and you don't have to do any of the work because you put your money to work. You use your money to buy an asset, to buy this house, and now your money through this asset is generating you passive income. And the best part of all is now you're creating a new income stream that you're earning without having to physically go to work. Because now if you have income coming in from your stocks, or if you have income coming in from your real estate, this is money that you're getting without you going to your job. Now let me give you a quick disclaimer here because there's a lot of kind of misconceptions out there about passive income and investing, with a lot of people on the internet saying, oh, you can become a millionaire overnight by just throwing your money in stocks or by throwing your money in real estate. Well, it doesn't really work like that. It is a slow, gradual wealth building process where the more money you put in, the better returns you will generally see, and the more time you have, the more money you will make. And that's when we come to number 5, putting fuel on the fire, where now you understand how to use your money, and now it's time to earn more money because you know how to grow your money even bigger. The reason I talk about this now, not earlier, is because a lot of people think that the solution to their money problems is just earning more money. But there's a little problem with that. If you don't know how to manage your money with $40,000 a year, you're not going to know how to manage your money suddenly at $400,000 a year, or even $4 million a year. That's why 70% of lottery winners become broke or bankrupt within just 5 years of winning the lottery. And that's why 78% of NFL players who make a ton of money while they're playing in the NFL end up broke or bankrupt within just 2 years of retiring from the NFL. Making more money does you no good unless you know how to use your money first. That's why once you know how to use your money, it's all about putting fuel on the fire, because now you have a financial system. You've built your savings cushion. You're no longer bleeding cash, and now you're putting your money to work. Once you do that, it's all about amplifying the system by earning more money and putting fuel on the fire. The way you do this is going to depend on you. For some of you, that might mean asking for a raise or working to get a promotion, something where you can get more money from your job. For others of you, maybe you're working a job, but you also really like baking cakes. If that's the case, now you can start a side hustle where on the weekends, you're baking cakes and you're selling it to your friends and your neighbors and other people that like your cake. And for others of you, you might have an entrepreneurial bug where you just really want to start a business. The whole purpose here is now when you make more money, you don't just go out and buy a fancy car. You follow your financial system. You're going 75, 15, 10, or you're going 50, 30, 20. Whenever you make more money, you're just taking that money and you're putting it into your funnel. That way you're investing more money, you're saving more money until you have the savings cushion built up, and then you're spending a little bit more money. The whole purpose of all of this is to manage your money in a way where you're paying yourself and you're building your wealth first before you go out and spend all your money and make all of those companies around you rich. If you had to turn this $100 bill into $200 as fast as possible, what would you do? This is one lesson that everybody should learn before they graduate high school, and by the end of this video, you're gonna know exactly how to do that. The answer that the majority of people would give is take that $100 to the roulette table and put it all on red, except it doesn't matter which seat you sit on or what time you go, you're probably going to lose that money. Rich people have figured this out though. They figured out the game of how they can double their money as quick as possible, which is how they're able to compound their wealth, and it's all because they understand this one concept of compounding your money with growing contributions. If you can understand that idea of compounding your money with growing contributions, you will know how to double your money, triple your money, quadruple your money. If you put your $100 into your savings account in the bank, you might be able to get a 1% return on your money if you're lucky, and it's going to take you 72 years to double your money. If now you take your money and you passively invest it into the stock market, you can expect to get a 7% return on your money over the long term. That doesn't mean you're going to get 7% every year. Some years are going to be more, some years are going to be less. But over the last 100 years, we've seen that you should be able to get a 7% annual return on your money, which means it will take you 10 years to double your money. Now, if you want to be a little bit more actively involved with your investments, where you don't just passively put it in the stock market, but you're looking for good companies, you're looking for good real estate investments, you're actively finding better investments, well, now you might be able to get a 10% return on your money. If you can get a 10% annual return on your money, it's going to take you 7 years to double your money. But if you can get an even better return, if you can get a 20% return on your money, well, now you can double your money every 3.8 years. And if you're wondering, but Jaspreet, where in the world am I going to get a 20% return on my money? Well, your credit card company is doing it each and every year. So if you carry credit card debt and you're paying interest on this credit card debt, you are making your credit card company rich at the expense of your future wealth. Then, if you can get a 50% return on your money, well, now you can double your money every 1.7 years. Again, you might be saying, but Jaspreet, where in the world am I going to get a 50% return on my money? Well, now if you can go out and start a business, you might be able to grow your business by 50% year over year, especially in the early stages of your business. You see a lot of startups grow by 20 to 50%, especially in the early 5, 6, 7 years of their business, because now you're able to grow, you're able to acquire more market share, and you're able to get bigger profits. But if you're able to get a 500% return on your money, well, now you can see your money double every 5 months. Again, you might be saying, Jaspreet, where in the world am I going to get a 500% return on my money? Go to the roulette table, you go to the casino, you can get a 500% return on your money, you can double your money every 5 months. However, you're probably going to lose your money. So the chances of you getting this are very low. This is where the next thing you have to understand is risk versus reward. Higher up here, you have much less risk. Down here, much higher risk. Down here, much higher reward. Up here, much lower reward. I don't recommend anybody take their hard-earned money and try to double it in the casino as a financial planning method. That is not what I'm advocating for. But what I'm saying is you have to understand higher risk comes with the potential for higher reward. Starting a business can make you extremely wealthy. It can make you a ton of money. It can make you more money than you ever imagined. But it's a ton of work. It's a ton of risk. The majority of businesses will fail. Then out of the small businesses that succeed, most of them will never make $1 million in a year. And out of those companies that make $1 million in a year, most of those will never make $1 million worth of profit a year. It is very difficult to scale a business and make it successful. However, that return potential is there. You don't have this type of return potential when you put your money in the savings account. When you put your money in your savings account, you know your $100 is going to be $100 tomorrow. It's going to be $100 in a year. It's going to be $100 in 2 years. Maybe a few extra pennies added to it. It's safe, but you're not going to get any returns. And this is where now you have to understand that risk and reward, but you also have to understand what I said just a minute ago, the compound interest with growing contributions. This is where things get really fun, and this is what rich people love doing. So I gave this example before, but let's assume that you can invest $4 a day. You start doing this from the day you turn 21, and you do this for 45 years, and you can get an average 10% return on your money, which historically has been the S&P 500 index average over the long term. This doesn't mean you get a 10% return every year, but if you put your money into the S&P 500 index 100 years ago, you would have averaged a 10% historical return. But if you do this, your $4 a day over the course of 45 years would have been just under $66,000 that you invested. But because you're able to get this 10% annual return, your money would have grown to $1.1 million. But what if now you don't just invest $4 a day, but you do growing contributions, meaning every year you contribute a little bit more than $4 a day. Every year you contribute, let's just say, an additional 5%. That means this year you're investing $4 a day. Next year, you start investing $4.20 a day. The year after that, you start investing $4.41 a day, and on and on and on, because every year you're working to get a raise, you're working to earn more income, and as you earn more income, you also invest a little bit more aggressively. Well, if you do that, and you keep the same years, you do this for 45 years, you get the same 10% annual return, well, now you're not going to have $1.1 million. You're going to have over $2.1 million. You just added an additional $1 million to your bottom line, to your investment portfolio, to your cash, because you started investing a little bit more aggressively. Because what happens? Inflation happens. 45 years from now, $1 million is not going to have the same buying power as it does today. But you're also not going to be earning the same amount of money. So if you can grow your investments, well, now you're going to be able to grow how much money you can have when it gets closer to your retirement age. And if you're wondering, but Jaspreet, what if I don't want to wait until I'm 70 years old to start enjoying my money? Well, I'll talk about that in just a little bit. But this is where understanding that if you can grow how
how much money you're investing, you can significantly increase how much money you will have. We're talking about $4 a day here. But if you can increase how much money you're investing each and every year with the income that you're making, so every time you earn more money, you invest a little bit more aggressively, well, now you're going to be able to grow your wealth. But it gets even more fun, because what happens now if you invest more money because you're earning more money, but you also invest more money because your investments are making you more money? This is where the power of compound interest really starts to come in. Albert Einstein called compound interest the eighth wonder of the world, and the reason why it's so powerful is because the people that understand it can become incredibly wealthy. But the people who don't understand it, well, you're going to be subservient to the people who understand it. Because now what you can do, not only can you grow your money, but let's assume that now your money is spitting off some cash flow because you're investing in dividend paying stocks, you're paying in rent producing real estate. Well, now you have some cash flow coming in. You got these returns, which is great, but you have cash flow, and instead of spending this money, you also throw this into here. So now instead of having a 5% annual contribution, maybe you have a 9% annual contribution, because you're working to not only increase how much money you're investing, but your investments are also throwing more money back into here. Now take a look at this. You're still investing your $4 a day right now, but every year you're working to increase your annual contribution by 5%. You do this for 45 years, you get a 10% return on your money, but assuming that you can get 4% cash flow, and you take that 4% cash flow and you put it in here, now your annual contribution is going to be growing by 9%. Now you're not going to have $1.1 million. You're not going to have $2.1 million, but you're going to have more than $4 million in your investment fund, because now you had the power of compound interest with growing contributions. This is what wealthy people are learning to master. Now the question is, what do you do to get this 10% return right here? What do you do to get this return on your money? Because time is one of the most valuable aspects, right? There's three aspects to this. It's how much money you're investing, how much time you invest for, and what type of returns that you can get. Well, this is going to depend on your income. If you have an income problem, you should be working to increase your income. Invest this money in your own education. Go and watch YouTube videos, go read books, go take classes, go get coaching, go get consulting, go do something to invest in yourself to learn how to increase your income. If you don't have the money to invest, you have to start with that. Figure out what can you do. Cut expenses, make more money so you have more money to invest. Once you do that, now you can't change too much about where you are in your life right now. If you're 21, great. If you're 18, great. If you're 45, great. You start where you are now. If you haven't started yet, you need to start now, so you just get started. Sure, if you're older, it's going to be a little bit tougher. Doesn't mean it's impossible, but then you can make it up here. If you're older, it's going to be more important for you to earn more money, to have more money to invest, right? It's all a formula. These are the three different areas where you could improve. If you can't improve here, you got to work to improve here, where you can work to improve here. So if you can't improve in one place, you got to find the other place to improve. Then this is where you can also improve how you can get better returns. And this doesn't mean that you have to go out and just throw your money at the casino, but how can you strategically get better returns on your money? I'm not going to talk about this in this video, but I want to talk about this. Let's jump back to risk versus reward. Now, before I go deeper, if you do want to learn how to be a better investor and you want to stay up to date on what's happening in the financial markets, if you haven't already, I would highly recommend you join Market Briefs. Market Briefs is my free newsletter that I created, which keeps you up to date on what's happening in the financial markets, from the stock market to the real estate market to crypto to the global economy to our own economy. That way you can understand what's happening in the markets so you can make smarter decisions with your money. Market Briefs is completely free and you can read it in less than 5 minutes every morning. So if you haven't joined Market Briefs yet, I'll put the link to how you can join Market Briefs down in the description below. We talked about risk and reward, but there's one more aspect that I didn't talk about, which is time in the economic cycle. Now, this doesn't mean that you need to time the market, but understanding that different phases in the economic cycle are going to give you different returns. And I'll explain what that means. When I first started investing in real estate, this was after the 2008 crash. And I was very fortunate that I started investing then because I didn't know anything about investing. I just started investing in real estate because the books that I read said that wealthy people invest in real estate. I didn't know any real estate investors, but I decided to do it. And when I started investing in real estate then, for me, I thought a decent return wasn't a 7% cash flow. it wasn't a 10% cash flow, it was 20%. This is going to sound very crazy, especially in our economic cycle right now, but back then you were able to find good homes in good areas for $50,000, and then you would be able to rent them out and make $10,000 a year of profit. That's a 20% cash on cash return on your money, and now those $50,000 homes are selling for $150,000 to $300,000. Here's another example. Again, I'm not telling you what to invest in. I'm just giving you examples. You always want to do your own due diligence and never blindly trust a random guy on YouTube. So, when you had the 2020 pandemic hit, you saw the entire stock market get cut in half. Well, you have some high dividend paying ETFs. These ETFs focus in on just high dividend yields. A few examples of this are SDY, SCHD, and VYM. For a disclaimer, I do have some of my own money invested in SCHD and VYM. Well, when the stock market got cut in half, the prices of these high dividend yielding companies and ETFs were also cut in almost half. So you saw these high dividend yielding ETFs, which normally yield somewhere between 2.5% to 3%, now saw their prices cut in almost half, which in effect meant that you could buy the same cash flow for almost 50% off. And so you were almost able to come in and buy the same dividend yield and now get a 5 to almost 6% return on your money, a 5 to 6% yield, just because you can buy these ETFs for almost half off. Now, I like cash flow because cash flow is king, but this is where you need to balance the three aspects. You have risk, you have reward, and then you have the timing. There's always going to be opportunities, but in order for you to find these opportunities, you have to be financially educated and you have to be willing to take on risks, because anytime you see these big opportunities, everybody is running away. When the 2020 pandemic hit, people were running away from the stock market, people were selling out of the 401ks, people were scared, but it created big opportunities for people who started buying good assets. When the 2008 crash happened, people were running away from real estate, but it created good opportunities for people who were buying real estate then. When the 2000 dot-com bubble burst, people were running away from internet companies, people were selling off all of the digital tech companies, but it created huge opportunities for people who came in and bought then. So it creates opportunity if you have that financial education and you're willing to take that risk, but most people don't have it in them to do that. So then you focus in on the risk versus the reward and you ignore what's happening in the economy. So you ignore what the timing is, you ignore what's happening in the economy, and when I say timing, I don't mean timing the market, but I mean looking for the opportunities, the big opportunities when they come your way. If you're not willing to do that, no big deal. Now you understand the risk versus reward. Here, you have no risk and also no reward. Here, high risk, high reward. Starting a business is very risky, but it can be extremely rewarding. The way that you can move down this list and get better returns without taking on a whole bunch of risk is through your education. Education is how you lower your risk. And how do you become educated? Well, you can read books, watch YouTube videos, take classes, get courses, get education, get coaching, get whatever, but you also got to make the mistakes. No education through somebody else teaching you can bypass the mistakes that you have to make, because you got to be willing to learn. In order to go from here to here, you're going to have to make some mistakes. Those mistakes are going to cost you money. Those mistakes are going to be painful. Those mistakes are going to make you want to rip your hair out. But that's what's going to allow you to go from this return to this return to this return. And you have to be willing to go through these mistakes if you want to get better. So how do you get better? You get started. How do you get started? By just doing it. Now you do it, you make mistakes, and then you get better. You learn, you screw up, and you make better mistakes, because now as you make mistakes, as you lose your money, you're not going to want to do it again. You're going to want to see what it was that made you lose money in the first place. And this is where a little bit of an investing 101. Don't invest more than you're willing to lose. If you're not willing to lose that money, your money that you invest has to be separate than your savings. It has to be separate than your spending money, and it's its own money. The money that you invest is a separate portion of money that's investment in you, investment in your assets, investment in your future wealth. You're gonna see dips. You're gonna see times where you lose this money, but that's how you learn, that's how you get better, and that's what's gonna allow you to get the better returns. Most people are never willing to go through that process because they never wanna look stupid. They never wanna make those mistakes. But if you're willing to look stupid, then it doesn't matter if you make a mistake, because now you can laugh at it and then you can learn how to be better. And I know it's very hard to laugh when you're losing that money, because I've been there. I have made very bad investment decisions when it comes to things in my own business. I've made very bad investment decisions when it comes to my real estate investments. I've made very bad investment decisions when it came to investing in startups. I have made very bad investment decisions when it comes to investing in the stock market. but I've also made some very good decisions. And those very good decisions have very much outweighed the bad decisions that I made. And those bad decisions were what set me up for the good decisions. So you have to be willing to make the bad decisions. That way you can make more good decisions in the future. Everyone talks about how you should follow the 4% rule. That way you can retire wealthy, which says that you need to save up a big enough nest egg. That way once you retire, you can pull out 4% of your assets each and every year. That way you can retire wealthy, but that might not be the best way for you to actually retire wealthy. I'll show you why. According to CNBC, if you follow the 4% rule, you should be able to fund your retirement for 30 years. Let me explain. Over the course of your career, you would work to save and invest your money. That way you can one day have a nest egg, let's say worth $1 million when you retire. Now, when you hit retirement, you should be able to pull out 4% of this, which is $40,000 that you can now use to live off of in year 1 of retirement. Year 2, well, you're not going to have $1 million. Now you're going to pull some money out. Now you're going to have $960,000 here, and you're not going to take 4% of this number. You're going to take this number and pull it out of here, but then factor in inflation, because when the 4% rule was created, it was created back in 1994 by a guy named William Bengen, and back then we had inflation between 2 and 3%. So if you had 2% inflation, that means now you would pull out not $40,000, but now you're going to pull out $40,800. That way you have enough money to continue funding your life as well. But what happens now if you're facing high inflation? Because now let's just say instead of 2% inflation, let's assume that you're facing 6% inflation. That would mean that you'd have to pull out not $40,800. You'd go from pulling out $40,000 to $42,600. That means now each and every year, you're going to be pulling out more and more money, which means your account size is going to be shrinking much faster. If you consistently saw 6% inflation, now this wealth that you built up isn't going to last you 30 years. It's only going to last you 16 years because you're pulling out the money way faster than you originally thought. Now you might be thinking, but Jaspreet, what if instead of just saving this money and having it not grow, you took this money and you kept it invested? And you could do that with the goal of now seeing this money grow as well as you pull out more money, but then you also risk seeing this money get cut in half if you face a market crash. So now what do you do? Is there an alternative? Because there is an alternative that you can consider as well. Now look, just to make sure we're on the same page, I'm not a financial advisor. I'm just a random guy on YouTube. I'm here not to tell you what to do. I'm just going to tell you the things that I see and some things that I do, because I just want you to be more aware. That way you can make more educated decisions for yourself. But of course, if you have questions, make sure you talk to a licensed advisor in your area, and don't blindly trust a random guy on YouTube because, well, investing has risks. I like investing for cash flow. And when you invest for cash flow, you do your investment analysis a little bit differently, because now I start with the end. If my goal is to make $40,000 a year from cash flow from my investments, this is money that my investments are paying me that I don't have to go to work to earn. Now I have to go work backwards to see how much money do I need to invest to actually get this $40,000 a year. And I'll show you how to do this. But if your investments pay you, say, a 3% return, 3% cash flow, not 3% growth in the value of the investments, but 3% of cash flow, which is money I'm getting without having to sell my investments, now I would need to invest $1.3 million to generate this $40,000 a year in cash flow. If I can get a 5% cash on cash return on my money, now I would have to invest $800,000 to generate this $40,000 a year. And if I can get a 7% return on my money, now I'd have to invest $570,000 to get this $40,000 a year in cash flow. Why does this cash flow work? Because now when you see inflation, in theory, you would want to be investing in good assets that are also growing the cash flow. Now, is that always the case? No, but with the right financial education, you can have the right assets, which mean your cash flow will also be increasing when you have more inflation. For example, over the last number of years, when we've been facing this high inflation, not only have we been seeing rent prices grow, which means if you're a cash flow investor in real estate, your rental income has been growing, but also in the stock market. If you're a cash flow investor in the stock market, chances are you've been seeing your dividends grow as well. Now, does this mean that rents and dividends always grow? No. When you go through an economic slowdown, rents can get cut, dividends can get cut, But this is where you have to understand the different ways that you can invest your money, that way you can get paid in more than just one way. Let me start by talking about how you can do this in the stock market. First, by individual stocks, and then second, if you don't invest in individual stocks. Now, I'm not recommending any of the stocks that I'm about to talk about. Bankrate put out an article going over some of their favorite dividend-paying stocks. I'm just going to highlight some of the stocks out of this, so make sure you do your own research. But if you look at the list, number 10 is 3M, number 9 is Walgreens Boot Alliance, number 8 is Philip Morris, and number 7 is AT&T. So let me talk about these. Now, to figure out if a company is paying a dividend or not, or to see what a company's dividend is, you can just go to a site like Yahoo Finance, and what you'll see that at the time when we're recording this video, 3M is paying about a 5.8% dividend, Walgreens Boot Alliance is paying around 5.7%, Philip Morris is paying around 6%, and AT&T is paying around 6% as well. That means based off of these numbers, you'd have to invest right around $700,000 into one of these stocks in order to generate $40,000 a year of cash flow. Now again, the goal with investing in a cash flow company is that now you're investing in a good company, so that when you see a growth in that company, dividends will also grow. And if you see high inflation, the company would also see growth in their dividend potential, so that way you would also generate more cash flow. Is it guaranteed? No, but the idea now is you're working to invest to generate cash flow. But then the next question is, how do you research a company? How do you keep up with a company? How do you know if each one of these are a good investment or not? Because the risk is, well, you could put all your money into AT&T, and now you're hoping that you're going to generate cash flow, but then AT&T could go bankrupt. Now, not only are you not getting any cash flow, but your money goes all the way down to zero, so you lose all of your retirement money. Now what? Well, there are alternatives to investing your money into individual companies, because most people probably shouldn't be in the business of investing their money into individual stocks, because it takes the right psychology, it takes the right financial education, it takes the right patience, and most people aren't interested in learning how to do that, and maybe they don't have the right psychology to actually implement that. So if you don't want to invest in individual companies or do that research, what's the alternative? Because this can be very risky, because now you can see all of your money go down to zero. Well, the alternative would be to invest your money into a fund with the goal of generating cash flow. So let me start by going over a US news article that highlights some high dividend paying ETFs. By the way, if you want to read this US news article or the Bankrate article, I'll also link them for you down in the description. A few of the high dividend paying ETFs that this article mentions are SCHD, VYM, NOBL, and SDIV. What you'll see is at the time when we're recording this video, SCHD is paying about 3.4%, VYM 3%, NOBL 1.9%, and SDIV 13%. Now, before I dive into each one of these, I want you to also understand that you should never make an investment based solely off of what this dividend number is, because this dividend number can be very deceiving. Because, for example, let's say you were thinking about investing in a company that's currently trading at $100 a share that's paying out a $2 dividend. That's a 2% dividend yield. But then let's say something bad happens to the company and the stock price falls to $20 a share, but they're still paying out the $2 dividend. That would mean that the dividend value has gone up to 10%. Now, if you come in and buy because you see, oh my God, that's a 10% dividend, you're going to be very excited. But what you don't see is that maybe this company is on the verge of bankruptcy, which is why the stock price is falling and they haven't cut or stopped their dividend yet. That's why understanding the dividend is just one part of your investment equation, and you should never invest in anything based solely off of what this dividend is. I also have to let you know as a disclaimer that I am personally invested into SCHD and VYM. Before you invest in any fund though, you want to know what your fund is actually investing in, because now when you invest in a fund, you could be investing in hundreds of different companies, and you want to make sure you're investing in a fund that's giving you exposure to the thing that you want. And how do you research that? Well, every single index fund or ETF or mutual fund is going to have a website that explains what it does. So let's go over the different ones, and I'll start by SCHD. At the top of this website, it says that this is the Schwab US Dividend Equity ETF, meaning this invests in US companies that pay out dividends, and the objective is to track as closely as possible the total return of the Dow Jones US Dividend 100 Index, so that tells you what it does. For VYM, you can see that this is the Vanguard High Dividend Yielding ETF, and if you go to the product summary on the right, it says that this provides a convenient way to track the performance of stocks that are forecasted to have above average dividend yields. And then if we highlight the why should you invest in Noble, what it says is that this is the only ETF focusing exclusively on the S&P 500 dividend aristocrats, which are high quality companies that have not only paid dividends, but have grown them for all of at least 25 consecutive years, with most doing so for 40 years or more. And then finally, we have SDIV, which is the Super Dividend ETF, which says that you want to consider investing here because of the high income potential, because SDIV invests in 100 of the highest dividend paying equities, meaning companies around the world, potentially increasing a portfolio's yield. This is how you would start your analysis to see if any of these funds are investing in things that you would like, and then you would dig deeper to make sure that the companies that they're actually invested in, again, this is all on the websites for each one of these ETFs. If you want to find them, just go to Google and search any ETF where you can find new ETFs. There's so many ETFs out there. Go out and find some ETFs and just start researching, and that will start to show you what you are actually investing in. Now, just for full transparency, the majority of my investment portfolio is cash flow producing assets, and I invest my money in different places. Now, again, I'm not telling you what to do. I just want to be completely transparent so you understand where I come from when I make these educational videos. My number one biggest investments are into my own business, but I don't consider that your passive investments because I'm actively operating and managing my businesses. My next biggest investment would be my real estate investments. I would put that here because I invest in real estate. That's my largest investment, and this is all cash flow producing assets. When I invest in real estate, I'm working to generate cash flow. Then I have my active stocks, and that would be me investing in individual companies. And then I have my passive stocks. These are me investing in ETFs and funds through a passive system, like I was talking about, where every week for me, I have a system where money is automatically being pulled out of my checkings account and is automatically being invested into my portfolio of ETFs. This happens for me every Wednesday. It happens every week. It doesn't change based off of what's happening in the markets. And the bulk of my passive investments in the stock market are paying me with cash flow. A big chunk of these stocks are also paying me with cash flow. So about 75% of my investment portfolio is cash flow producing assets. So between here and here, about 75% of my total investment portfolio are paying me with cash flow. Then I have some more of my speculative types of investments. Like here, I have my startups. This is a smaller piece of my portfolio where I'm investing in other startups. These don't pay me with cash flow. This is where now I'm investing in these companies, hoping that one day they're going to be worth a whole lot more money, but they're probably going to go to zero, or a big chunk of them will go to zero. That's the reality of investing in startups, that most investments will go to zero. Some of them will hopefully grow and make up for all those losses. Then I have some crypto. I own a little bit of crypto. It's a very small piece of my portfolio. That's kind of the fun. I believe in the value of crypto and Bitcoin for the long term. If it goes to zero, well, it's a tiny piece of my portfolio. If it grows, well, that would be nice. And then I own some physical gold. Again, this also doesn't pay me with cash flow. This is my insurance. This is my doomsday scenario. About 2% of my total investment portfolio is gold. So it's a very small piece of my total portfolio, but it's there kind of like insurance to protect me against worst case scenario types of situations. So now, for me, I like cash flow because now I can keep working to grow the cash flow. I am constantly investing my money, like in my passive stock market investments. I'm investing money every Wednesday, and this is working to buy me more cash flow. Then, when I get paid with my dividends, these dividends are automatically reinvested to also buy me more cash flow producing assets. So it's like a machine that I'm constantly working to buy more of these cash flow producing ETFs, and then these cash flow producing ETFs are buying more of the ETFs every time I get paid. I use a platform called M1 Finance. They are a previous sponsor from Minority Mindset. I like them because they make it very easy to use. They have a lot of free resources to start investing. If you want to learn more about them, you can use my affiliate link, meaning if you use my link, we will get compensated. You can do your research, find a platform that you like, but if you want to use my affiliate link, I got that link for you down in the description below. The second way that you can start generating cash flow is by investing your money in real estate. Now, when I invest my money in real estate, I invest my money not to flip my property for a big profit. I invest my money for one reason, which is cash flow. Because I can, one, predict how much cash flow I'm going to get way better than I can predict how much a property is going to be worth in 2 years. And second, cash flow is much more stable. I'm not worried about future speculation because if property prices fall, oh well. I'm investing for cash flow. So the way that I invest my money, I look for a 7% cash on cash return on my money, meaning for every dollar that I invest, I'm looking for 7 cents of profit from cash flow from the property. This does not include appreciation. If appreciation happens, that's icing on the cake. That is the cash flow that I'm getting. So if I was to invest $100,000, let's just say, into this property, and I bought this property all cash, I would want $7,000 of profit being deposited into my bank account after paying all of my expenses. And the expenses include your property taxes, your insurance fees, your maintenance fees, your management fees, because I don't manage my real estate myself. I have a property manager that handles all the day-to-day work and covers any of the vacancy costs. So now, after you cover all the expenses, that's the type of return that I'm looking for. Now, if you're a real estate investor, you might be saying, wait, how are you getting a 7% cash on cash return on your money? Because this depends on where you are investing your money. There's certain areas around the country that are going to see 1 to 3% cash on cash returns. You have other areas in the country that might be 3 to 5% returns, and you have other parts of the country that might be 7 to 10% returns, and then you have other areas that will be 10 to 15% returns. Now, just like with dividends, you don't just want to look at this return by itself, because this doesn't tell you the full picture. Because in real estate, the higher the return can also be the higher the risk. Because now if you're investing in an area that's giving a 15% return on your money, chances are you might have more risk. You might have a tougher time finding a good tenant. You might have more evictions. You might have more crime in the area. You might be investing in an area that's not seeing much business growth. And so you have to understand now that more return also comes with more risk, and different parts of the country are going to have completely different types of returns. And this is where now your job as an investor to find the sweet spot for you. What types of returns are you looking for? This for me is where I'm looking right now. Now, could this ever change in the future? Sure. But for me, these are the types of returns and the types of deals that I've been able to find my sweet spot, because I look for distressed properties. And these could be physically distressed or financially distressed. A physically distressed property is what most people will call a beat up property. You walk into a property, it smells like crap, the carpet is disgusting, there's holes in the walls, it just doesn't look good. I like these types of deals because now I can come in and find a deal that nobody else wants to buy. So then I get to come in and buy it at a discount, and I have a good team in place where we can come in and rehab and turn around the property at an affordable price. And now I get a fully remodeled, very nice looking property at a below market price. That way now I can already increase the returns that I'm getting. The alternative is a financially distressed property. This would be something like an apartment complex where now it was mismanaged. The previous owners had too much debt, or they didn't know how to manage the property, and now this property is essentially vacant, or tenants are not paying, or something bad is going on in this property in a good area where I believe businesses are growing. And now I would come in, buy this property, and have to put in the work, the time, the money, and the effort to turn this property around. And a lot of people don't like these types of deals because, well, it requires way more work and there's more risk associated with it. But if I know the area, I believe that's where businesses are going, I have a good team in place, which took a long time to build. Because I know a lot of people talk about real estate being this passive investment. You just put your money into real estate and you hand over the keys to your property manager and you're done. Well, in reality, it doesn't really work like that, because for me, when I got started in real estate, I had no experience. I had no one to guide me. I had no one to teach me. I just jumped right in because I wanted to invest in real estate, and I made every mistake possible. And it was essentially like a full-time job, because I didn't know what a good contractor was. I don't know where to find contractors. I don't know who a good attorney was. I don't know where to find good attorneys. And so I dealt with bad contractors, bad attorneys, bad accountants. And I had to go through the process, which was, one, very expensive, but two, very time-consuming. But over the years, over more than a decade now, I've been able to build a good team, figure it out, and put in the work, which makes it much more streamlined for me. So if you want to invest in real estate, understand that it can provide great returns, but know you're going to have to go through this hurdle. And this hurdle is, one, a time hurdle where you're going to have to put in the work, not only to learn by reading books, but then do the actual work by investing in real estate and making the mistakes. And understand that every real estate investor has a bad deal. I made a video of my worst real estate deal ever on YouTube. I covered it. That was, to date, the only deal that I've ever lost money on, but it was extremely painful, not just financially, but mentally, because of how draining it was. But these are the things that you learn how to deal with issues by going through screw-ups, by going through mistakes, by screwing up, by failing, and understanding if you're willing to go through that, then real estate investing can be a great tool for you to build wealth and grow your wealth. But it doesn't happen by itself. It takes time, it takes effort, and it's going to take a learning curve through you. And if you're willing to do it, great. But just don't believe all the it's completely passive, you don't have to put in any work stuff. It's going to be its own process, and it can be a great return, but you have to be willing to go through that process. Most people assume that if you want to manifest wealth, all you need to do is sit there and pray on this idea of wealth and abundance, and money is going to fall into your laps. But that's one big lie. If you really want to manifest wealth, I want you to understand this. There are two parts to really understanding money. Number one is the practical side, which is down here, and number two is what I like to call the emotional side of money, which is up here. See, when I got started in this financial education game, I used to think that money was just a numbers thing. That if you understood spending and you understood saving and you understood investing, you have the tools to become successful financially and become wealthy. It's understanding that the actions you take are going to have different outcomes. If you make good financial actions, you save money, you live below your means, you invest this money, you are going to achieve wealth. That's what made sense. But as I continued working in this financial education space, I started to realize that it goes even deeper than that. It goes into this, what I like to call emotional side of money, which is understanding how your thoughts play an impact on the actions that you take and how your subconscious plays an impact on your thoughts as well. And this is where now some people in this manifestation of money side of things focus here, that if you change the way you think, you're going to change what you get. Which is partially true, but you're skipping a step here on the actions. And this is where now, if you really want to manifest wealth, if you really want to attract money, you have to understand this entire process. How the way you think is impacted by your subconscious, how the way you think is going to impact your actions, and how your actions impact your outcome. This is a holistic view of really how you can attract money, how you can manifest money. And it's not just sitting there and praying on this idea of money, please come and enter my life. So let's back up a little bit and really understand now how you can understand this, that way you can start manifesting more money the right way. If you've ever watched any of my videos, you've probably heard me say something along the lines of, all success starts with your mindset. And the reason why that matters is because you can know everything about investing. You can know everything about saving. You can know everything about how to earn more money. But if you believe that you cannot become successful, if you believe that you cannot become wealthy, if you believe that somebody in your situation is going to be stuck for the rest of your life, it does not matter what financial education you have. It does not matter how much you know. You're never going to actually become successful because you have this roadblock right there, which is your mindset. And your mindset is very powerful because your thoughts here are going to impact your actions. And these actions are then going to impact your outcome. And this is where now many people start to talk about how you need to change the way that you think. Because now if you can stop giving yourself this negative talk, well, then you can start achieving different actions which can give you different outcomes. And that's the start. But there's something a little bit deeper than your thoughts that I want you to understand as well, which goes into your subconscious. Some people like to call this your pre-thought, where you might know that you can't become wealthy. But if you start watching the self-development education on the internet and you say, oh, if I start saying and I start thinking I can become wealthy, then I'll become wealthy. Even though deep down, you still believe that you can't become wealthy. You're just trying to talk to yourself and say, you know what, I'm going to ignore my subconscious thoughts, I'm going to ignore my pre-thoughts, and I'm just going to say and think that I'm going to become wealthy. See, these thoughts are lying to yourself. This is where now you really need to change your subconscious thoughts to really change your thoughts. Because that's what's going to really allow you to understand and manifest money, manifest this outcome, because you're really getting deeper into here. And the way that you do that is you kind of work to rewire the way that you think. Now, changing the way that you talk is one way to do that, but it goes even deeper into that personal development and the self-development and changing the way that you look at the world, the way that you look at abundance, the way that you look at wealth, the way that you look at success, and understanding that it is possible for you. And so in order to change the way you think, you can't just change the words that you say, you really have to change the way you think. And this takes real self-development, real personal development. And I don't care what type of background you have. Everybody needs some sort of personal and self-development in their lives. And you might think it's a whole bunch of weird, stupid stuff. Listen, go out and just read a couple personal development books out there. If you feel like you already got it, that you know what, I already have a positive attitude, I already got a growth attitude, great. Now you move on to here. But some people, some of you are going to need more than that. But this is where you got to understand that you have to understand this. If you do not have these positive growth, mindset, abundance thoughts, you'll never be able to get this. Now, some people stop right here. They go into this whole idea of manifestation, that all I need to do is hypnotize myself that I'm going to become wealthy. I just got to believe that I'm going to become wealthy. I'm just going to sit here and pray on this idea that I can become wealthy, and I'm all good, because I believe in this idea of abundance and manifestation. But you completely ignore the practical side of money, which is how do you actually get the money? See, there's a balance between understanding the emotional side of money and the practical side of money. You have to understand the emotional side of money if you want to become wealthy, that way you can actually take advantage of the practical side of money. See, this is the financial education. This is now what do you do with your money. This is now where do you invest your money. This is now understanding how do you spend your money. This is now understanding how you can earn more money, that way you can get a better outcome. But you can never get want this outcome, if you're sitting here beating yourself up, if you're sitting here worrying about what other people are going to think, if you're sitting here always beating yourself up, that somebody like you cannot become wealthy. And that's where you have to understand this emotional side of money as well. So if you want to understand this, invest in your self-development, invest in your personal development. Go out and watch podcasts on this. There's a bunch of great podcasts, a bunch of great pieces of content out there for free on your personal and self-development. That way you can change the way you think, the way you can rewire your brain, that way you can get rid of these negative thoughts, that way you believe that you actually believe, not just you're telling yourself, but you actually subconsciously believe and know that you're going to become successful and you're going to do whatever it takes. And if you don't think that's enough, go out and read some books, get some coaching programs, do whatever you got to do to change the way you think. I cannot emphasize how important this is because I have met with so many people across the world now on this financial education journey, and I have learned this firsthand that if you do not have this, this by itself is not enough to actually give you the full financial success that you're looking for. Once you got this, this is where now you invest in this, your financial education of how you can change your actions so you can get better outcomes. Now, this is all about understanding what's going on in the markets. How do you invest your money? Now, this is where, if you haven't joined Market Briefs yet, Market Briefs is a free financial newsletter that my team created to keep you up to date with what's happening in things like the economy, the housing market, the stock market, the crypto market, and the global economy. You can read Market Briefs in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs yet, I got the link to how you can join Market Briefs down in the description below, or you can go to briefs.co/market. That way we can start getting your Market Briefs for free. But now the question is, once you understand this, what do you actually do to emphasize and grow this outcome? What do you do to amplify your wealth? Well, that's where you keep focusing on this, because there's a limit to how far your thoughts can take you. But this is where now understanding that you have to think big enough that way you can take bigger actions. The thing that separates somebody who goes from $0 to $100,000 to somebody who goes from $100,000 to $1 million to somebody who goes to $10 million is how big you're willing to think. Because many times we create our own ceilings. There's a lot of money in the world. And I think it's sometimes really hard for us to fathom how much money is really out there. But our central banks, the Federal Reserve Bank, is printing money every single second. Our economy is flooded with more and more dollars. There's people with more money than you can imagine out there. And so yes, it is very possible for you to take your annual salary. If you're making $50,000 a year, guess what? You can take this $50,000 a year and you could turn this into your monthly salary, which means you could make $50,000 a month. And now this might seem absurd, but it is possible. But you can also take that and turn it into $50,000 a week. Might seem absurd, but it's also possible to turn this into $50,000 a day. Now the question is, how much action are you willing to do to actually make that possible? But in order to actually take these actions, you have to believe this is possible. Now, I know from experience that it can be very hard, depending on where you are, to actually believe that something like this is even possible. Because growing up for me, I remember thinking, $100,000, if I could make $100,000 in a year, that would be like the most amount of money imaginable. $100,000 a year and I'm gonna be living high and doing whatever I want with my money. And then I hit that $100,000 a year. And I realized, oh wow, if I did this, what's really possible? And I also realized that $100,000 a year wasn't really enough to give me anything close to the lifestyle that I was dreaming about. Then I got to the $100,000 a month. And I realized, holy moly, I never thought that I could turn that amount of money into a monthly income. And again, I'm making $100,000 a month and I realized this isn't as much as I thought it was going to be. So if you really want to start scaling your income, if you really want to start manifesting this wealth, it's not about you just thinking about wealth and sitting there and manifesting it into your laps without doing anything. It's understanding that you can become wealthy and actually deeply understanding that it is possible for you. It's changing the way that you actually think, not just the way you talk to yourself, but the way you actually think, changing your subconscious thoughts, which takes real work for most of us out there. Then, once you got this, it gets into the financial education of actually understanding how you put it to work. Now you can invest in this through your YouTube videos, through your podcasts, then through books, then through coaching, then through actually doing it. But this is where you gotta be willing to keep putting in the work, putting in the hustle, making in the sacrifice, taking the education. That way now you can actually see that success for yourself. But it starts with you understanding the emotional side of money and then the practical side of money, putting these together and putting in the work. And that's gonna give you an unstoppable force to actually really manifest that wealth for yourself. Most people assume that being rich means you have a big bank account. But if you ask a rich person what it means to be rich, they'll tell you something completely different. Take a look. See, the thing that wealthy people do is that they use the cash in the bank account as a means to an end. They use the cash as a means to get other assets, which is what they actually want to own. They use the cash to buy stocks. They use the cash to buy real estate that's producing rental income. They use this cash to buy businesses, or they use this cash to buy other hard assets, things like physical gold. Versus for the majority of people, the goal is to have a lot of cash. Their goal is to have a big bank account because we think that if you can have a lot of cash in the bank account, you're financially free. And I'm telling you this from experience because growing up in our traditional Indian house, the whole concept of financial education was you work to earn a big salary and then you work to spend no money. That way you can save as much money as possible. So you don't spend money, but then you just store this cash in the bank because now you hope and pray that this cash in the bank is going to make you financially free. Now, it's better to have cash in the bank than to have no assets and no cash in the bank, but there are better things that you can do. This is for all of you Indian uncles and aunties out there that are listening and trying to figure out what to do with their money. What you have to understand is that the cash in your bank is losing value for the last number of decades. Now, I'm not just talking about what happened post 2020. Even if you look back for the last 5 decades, our cash has been losing value year after year after year. The reason why is because of inflation. Now, sure, you can try to grow this cash by putting it into a high interest savings account, but at the end of the day, you're going to be losing relative to people who are investing their money into these assets. So what wealthy people want to do is they want to take the cash and use this cash as a tool to then go out and buy stocks, real estate businesses, or other hard assets. Now, I want to clarify this. This doesn't mean it's bad to have cash. You want to make sure you have cash for 3 reasons. Number 1, you want to have cash to protect you against an emergency. So for that, maybe somewhere between 3 to 12 months worth of expenses saved up to protect you against an emergency. And this is going to depend on your risk tolerance. If you're 25 years old, you don't really have any liabilities, you're okay taking on more risk, you don't need 12 months worth of expenses. Maybe you only need 3 months worth of expenses. If you're 47 years old, you got a couple kids you got to take care of, you got liabilities you got to take care of, and you don't have a very high risk tolerance, now maybe you need 9 to 12 months worth of savings built up. That way you don't have to feel so stressed about money. You find what that number is. The second reason why you save cash is to make a purchase. You want to buy a home, you want to buy a car, you want to buy something. Well, you need cash to do that. So you save up cash to make that purchase, or you save up cash to buy one of these investments. Warren Buffett talks about his huge multi-billion-dollar stockpile of cash because he's waiting for the perfect investment opportunity to deploy his cash. Now, this doesn't mean that you need to wait to find the perfect investment opportunity to start investing. Not everybody is Warren Buffett. But what this means is you have to understand what is the purpose for your cash. And you have to come up with the right investing strategy for you. And I'll tell you what I do. I don't recommend what I do to anybody else, but I tell you what I do just for educational purposes. I have a system where every Wednesday, cash leaves my checkings account and is automatically invested into stocks. And it does not matter what's going on in the world. This is going to happen every single Wednesday. But in addition to this Wednesday investment into the stock market, which is going into, by the way, ETFs, which gave me exposure to the broader stock market. So I'm not investing in individual companies with the Wednesday investments. But in addition to that, I also have money individually going into stocks. I have money individually going into real estate. I have money individually going into businesses. And I also have my money going into physical gold, but this happens automatically once a month. Now, when I say individually into businesses, real estate, and stocks, what I mean by that now is I am working to build up cash piles. That way I can go out and find investments to actually invest in. This is because I enjoy doing this. This is something I want to do. You don't have to do this. But now what I do is when I have this cash pile built up, I will look for a place to invest it. Maybe it'll be in a startup. Maybe it'll be in my own business, Briefs Media, that I run. Maybe I'll go out and find a rental property for me to invest in, or an apartment complex, or a single family home. Maybe it'll be a stock for me to go out and invest in. This is much more active, where number 1, I'm going out and I'm trying to find this individual investment, and I'm trying to find a good price, and I have to manage this investment itself. But this takes more work. It's not automatic, it's not passive, but this is in addition to my automatic and passive investing strategy. So now what you want to do is understand, okay, what do I need to do to become wealthy? The way you become wealthy is not just by stacking cash. That's good that you're saving cash. That's good that you're stacking cash. That's part one. But now you want to do part two, which is convert this cash into an asset that's actually going to pay you for owning it. But then there's also part three, and you got to understand the life cycle of an investment, which is investments don't go straight up forever. Investments go up and they go down. And the people that actually make money from their investments are not the people that make an investment for 6 months or 6 days or even 6 years. These are now the people that are investing their money for the long term. And now if you can become a buy and hold investor, where now you're holding onto investments for the long term, maybe even forever, now you have the opportunity to make much more money. But this requires you to build that psychology and understand market crashes happen. It's a part of our economic system. You could see the value of investment go down. But if you own good investments, that creates opportunity for you to go out and buy even more aggressively when things go wrong. And this is where it requires that psychology, because I always get these interesting comments of people saying, Jaspreet, I started investing my money into the stock market, but then 2 weeks later I saw my money go down. Should I sell my investments? And it's such a frustrating thing, because if you really want to build wealth, it is not something that happens in 2 weeks, 2 months, or even 2 years. You have to stay consistent with your investments. I call it a decade of sacrifice. A decade of sacrifice means you got to spend that time to spend less and earn more so you can invest the difference. And the reason why I say decade isn't just so you put your money to work for 10 years. It's so you can start building that foundation over the 10 years, that we can build a real nest egg, a real asset portfolio that can start spinning off some dividends, or they can start really seeing some growth. But you got to understand, markets go up, markets go down. Market crashes are a part of our economic system. They have happened in the past, and they will continue to happen in the future. Yes, the stock market will crash again. Yes, we will see a real estate crash again. But we also know that stocks are going to be around in the future. We also know that real estate is going to be around in the future. So instead of being the person that's panic selling and just running away, understand the way that our markets work. That way you can use this as an opportunity to go out and invest even more. Guess what? Wealthy people want to turn their cash into assets. Now, some people who are more involved with their investments are going to stack cash until they see a good investment. But for the average person who's not in the game of reading financial statements, who's not in the game at looking at individual investments, who's not in the game of managing their investments, who's not in the game of valuing their investments, the way that you win then isn't by now trying to find the best investment, because now you're gambling when you're competing against people that are devoting their lives to this. It's just by finding a way to keep regularly deploying your cash into your investments. Guess what? There are tools out there that will let you create an automatic investing system. There are apps that will let you invest in real estate, apps that will let you invest in stocks, that will do this automatically and passively right out of your bank account. This way, if you don't want to worry about all the work that's required to find a good investment and manage an investment, that's okay. You can just throw your money into the stock market, into a portfolio that gives you exposure to the total stock market, or to the S&P 500, or to the Dow Jones, or to the NASDAQ. And now all you got to do is just keep funding it. And this is how most people, the average person, can build wealth without having to take on all the stress of understanding how do you manage and find good investments. And this is where you got to remember, what are we talking about here? We're talking about taking the cash that you have, and you got to convert this cash into something that's going to actually make you money, because your cash in your bank account is not making you money. I don't care if your high interest savings is paying you 4%. If you have a high interest savings account, that's good. It's better than not having a high interest savings account. But you gotta remember, why are you saving money? Are you saving money to build an emergency savings account? If so, good. Are you saving money to make a purchase? If so, good. Are you saving money to make an investment? If so, good. But if you're just saving your money just to stack cash because you think that's what's gonna make you wealthy, that's what I want you to change, and I want you to understand that's the cash that I want you to convert into assets, because that's what wealthy people do with their money. Wealthy people want to own stocks, they want to own real estate, they want to own businesses, they want to own hard assets. This is what makes wealthy people wealthy. It's not this. Now, before I end this video, I'm going to give you a few resources. That way you know where you can go to learn more. If you're looking for an app that can help you invest your money into the stock market passively and automatically, we have a tool who's a partner of ours down in the description below. If you use them, we will be compensated, but that's a tool that you can use. I've used them in the past as well. Same thing with real estate. If you're looking for a tool that can help you invest in real estate passively, we have a partner of ours down in the description. Again, if you use any of our links down in the description, I will get compensated, but there's no additional cost cost to you. And third, if you're looking for a tool to stay up to date on what's happening in the financial markets, my team at Briefs Media writes a newsletter called Market Briefs every single day. It's completely free and it'll give you a breakdown of what's happening in the financial markets in 5 minutes or less. If you want to join Market Briefs, it's a ton of fun and I guarantee you'll love it. And if you don't love it, well, you can unsubscribe. It's free. All you got to do is click the link down in the description below or go to briefs.co/market to join. The majority of people say that if you want to earn more money, put in more work. Now, while this works to an extent, and while working hard is important, hard work by itself is the worst way to earn more money. The amount of money that you make is directly equal to the amount of value that you can monetize in your 24-hour day. The more value that you create, the more money you will make. The reason why Elon Musk or Jeff Bezos or Bill Gates were able to become so financially successful isn't because they're working 10,000 times harder than the regular person. It's because they were able to create more monetizable value than regular people. They did it through building a business and then hiring people to carry on their vision. You don't have to build a business to understand the productivity hacks that the 1% and that wealthy people are using to get the most value out of the 24 hours. Again, I'm going to be doing my video sitting down like this for a little while because I messed up my ankle, but there's 5 different ways that you can start using the same productivity hacks that wealthy people are using. And number 1, this one gets me in a lot of trouble every time I talk about this, is what I call the Netflix effect. If you're not happy with where you are financially, one thing that you have to cut right now is your Netflix subscription, your Hulu subscription, your HBO subscription, and whatever other streaming subscriptions you have. And now anytime I say that, the first thing that everybody says is, Jaspreet, what are you talking about? It's $10 or $15 a month. How is that going to make any real difference in my financial life? Well, you're looking at it at a very microscopic, narrow point of view because all you're looking at is the price, the dollar price that you're paying for the Netflix. But what you're not looking at is the real cost of this Netflix. Because if you're sitting down watching an hour or 2 hours or 3 hours of Netflix every single day, and you compound that day after day after day, and then you compound that week after week after week, and then you compound that month after month after month, and then you compound that year after year after year, and then you're complaining about you being broke, well, you can kind of see where if you didn't spend that time watching these random TV shows on whatever Netflix is showing nowadays, well, now you could use that time to do something to earn you more money. I want you to put a value on your time. Like if right now you're making $30 an hour and you're watching 2 hours of Netflix a day, that means your Netflix isn't costing you $150 a year. That means your Netflix is costing you the opportunity to earn an additional $10,000 a year because that's $30 an hour of TV that you're watching when you could have been using your time to earn some more money, maybe even increasing your hourly wage. Here's a few things that you can do that will give you a better ROI, return on your investment, than your time in Netflix. Number 1 is you go to work. Get a second job where you can work on your own business or you can work on your own side hustle. Do something that will produce you a direct income. Number 2 is you can read books, especially if this book has something to do with financial education, self-development, business education, investing, some sort of financial education. Number 3, watch educational YouTube videos. This is completely free. Watch videos on financial education, how to increase your income, different business ideas, how to manage people, how to get a better job, how to get a raise. Watch some YouTube videos that will teach you how to grow your income or how to grow your wealth. 4th, you can take online classes. There are classes on anything and everything that can help you to increase your income, increase your wealth. Number 5, go to the gym. If you need some time to unwind at the gym. At least you'll be burning some calories too. Or number 6, spend some time with your family. If you call Netflix quality time where you're sitting there quiet with your spouse or your kids, well, you're not really doing any quality time if you're both just sitting there quietly. Talk to your family, talk to your spouse, talk to your kids. Canceling your Netflix and reallocating that Netflix time towards something more productive will give you one of the best ROIs on any investment that you can make, because now instead of killing your brain cells watching something that's making you dumber, now you can use that time earning more money, learning how to make more money, getting healthier, or spending more time with your family. If you're happy with where you are financially, then go ahead, watch Netflix. Second is eat the toad first. That means do the hard stuff first, get it out of the way, that way the rest of your day is easier. Back when I was younger, I used to make a list of things that I had to do during the day, and then I would organize them from the easiest and the least time intensive thing to the most time intensive thing. And then what I would do to feel like I'm getting a lot of things done is I would start with the easiest stuff and then work my way down. And what kept happening was I would do the easiest things, get those out of the way, and I felt like I was doing a lot because I kept checking the boxes. I kept checking off the things that I would do. But then every time I got to the tough stuff, the real meat, the strenuous stuff, I'd always say, ooh, I'm kind of tired now. Maybe I'll save that for tomorrow. I'll save that for the next day. And then what would happen? The next day came, and now I make my new list of things to do. I got my easy things first, my quick things first, and now I got my hard, real, substantial things that I got to do. And then I get tired before I get to do that again. And now I keep putting off the most important things. That way I keep doing the crap work, the easy work, the simple work, but I never get the real work done. Now it's completely flipped. I start with the hard, the most important, the most strenuous thing, and I get that done first. For me, that is making YouTube videos. Making YouTube videos is pretty intensive because one, I gotta make sure all the scripts are done and all the work is done. And then typically I'm standing up, I'm in my recording room, I got my whiteboard, and I gotta go and put in a solid couple hours to record every single day. Now, obviously I'm doing it while sitting down because my ankle's a little twisted, but what I do is I don't do anything until I script and record my videos. So I start off the day, I put in the work in my videos, and then I start going down the list of the easier things because when I'm doing more of just my thinking stuff, that's a lot more easy and less strenuous on me. So I do the recording first and everything else after. Now what I've done is taken it one step further. I use food as a reward. I love food. And so now what I've done is I don't allow myself to eat until I finish up a certain amount of tasks. So I'll write down on my notes, and I make a list every day of things that I gotta do, but I write down the things that I gotta do before lunch, and I don't allow myself to eat until I finish up these tasks to keep me motivated. And sometimes I'll put food at the end of the day. That way now I won't eat lunch. I gotta finish up everything before I get to eat dinner. The third hack is don't do what you can pay somebody else to do when you're ready to pay somebody else to do it. Because I used to hear this a lot, that you should pay somebody else to do the things that you can pay somebody else to do. That way you free up your time. But if you do that early enough in your career or entrepreneurial journey or whatever it might be, now you're going to pay somebody else to do something that you could have done yourself. And now you have a whole bunch of free time because they don't know what else to do. So now you have less revenue or less income because you're paying somebody a piece of your revenue to do some of your work. And now you're just sitting there on your hands trying to figure out what else to do. If you have something else to do to be more productive, then do that. But if you don't have something else productive to do, then you got to be doing the work for yourself. When I started off making YouTube videos, it was a hobby for me. I wasn't making any money. I didn't plan on making any money. So it didn't make sense for me to go out and hire an editor in the beginning because, well, this was just a hobby. Why do I want to spend money on something that's not going to make me any money? Then when I started making money on YouTube, I still didn't hire an editor because I was working on some other entrepreneurial ventures, but I had the time to edit. And if I wasn't editing, I didn't know what else I would be doing. I would have just been sitting there on my hands. And so I wanted to save that money for myself. So I paid myself to do the editing. Then once I started to grow, I started to build other entrepreneurial ventures. I started to build my own businesses. I started to become more busy. Then I hired an editor. Now, when I had an editor, I paid somebody else to buy my time back, and then I had more time to do other things. Then I began to hire writers. That gave me more time back. Then I hired tech people. That gave me more time back. Then I hired more and more people, and that allowed me to have more time to do things that only I can do, where other people cannot. But you have to work your way up, because if you just start hiring people in the beginning, like what some people say, you're gonna be out a lot of cash. And that cash can be used for yourself to build your savings, to build your investments, to build your wealth, to have money to invest in other business ideas, to do whatever it is that you want to do. So you want to save as much cash in the beginning, but you also want to understand when it's time for you to let go and now hire people. That way you can grow that cash. See, if you're sitting there and now you're limiting yourself because you're saying, oh, I don't want to pay somebody to do my editing. I don't want to pay somebody to grow my business. I don't want to pay somebody to mow my lawn. I don't want to pay somebody to fold my laundry. I don't want to pay somebody to get my groceries because I don't want to spend that money. But your time could be used better somewhere else. Now you're losing. Now you're being cheap, and now you're wasting your own resources when you could be using your time to get a better return.
But if you don't have a better return and your time would just be you sitting there watching Netflix, doing something that isn't producing any return, then you can do the work yourself. But once you figure out a better way to spend your money, to spend your time, that is when you got to pull the trigger and hire people to buy you your time back. That way you can do the most productive things with your time. That way you can produce the most value out of your time. Like what I was talking about at the beginning of this video. All of us are given 24 hours a day. We're all given the same amount of time. Now, the thing that determines how successful you will become is how much value you can produce. Not everybody's going to be a business owner. However, you can be more productive with your time and do more things with your time that's going to produce you the most value, whether it's more time learning, whether it's more time earning, whether it's more time enjoying, whether it's more time being healthy. You got to figure out whatever that productiveness is, but you have to be willing to invest in the thing that's going to give you more time to do more of the things that you need to. Number 4, this is where the real wealth comes in, but own something bigger than you, because there's a limit to how much you can do, but there's no limit to how much you can own. If you're paid based off of how much you own, not only do you have an unlimited earning potential, but you also get some tax benefits as well. If you're paid based off of what you do, there's a limit to how much you can earn, and you're also going to be paying the highest taxes. Just look at the numbers. 98% of earners are making under $206,000 a year. If you want to be a multimillionaire, you want to be super rich, you want to be part of the elite wealth class, you're going to have to do something a little bit different, which means you might need to earn more money. Now, if you can't earn that from your job, then maybe you need to own something, because when you're just working a job, the only thing that you own is you and your own labor. But if you own the business, you own the entity, well, now you control the ownership of the business, and there could be hundreds of people, there could be dozens of people, there could be 2 people, there could be millions of people working in this entity, working to grow your value. When people work for Tesla, they're working to increase the amount of value that Elon Musk owns. When people work for Jeff Bezos, they work for Amazon. When Jeff Bezos was the CEO, they're working to increase his value. Actually, even though Jeff Bezos is no longer the CEO of Amazon, he's still one of the largest shareholders, meaning owners of Amazon. So when people work for Amazon, they're working to increase the value that Jeff Bezos puts out. Even though Jeff Bezos isn't working at Amazon, he owns Amazon. You can think of this ownership as a new person, and there's no limit to how much this new person, this business, can produce, can put out, because now there can be other people working within this entity. If you can own it, now you can increase the amount of value you can put out. Now, there's 2 ways that you can do this. One is you can build it. The second is you can buy it. Now, on a ton of videos, I talk about how you can buy these types of investments. I talk about how to invest your money, whether it's stocks or real estate or whatever it might be. When you invest in the Amazon Corporation, you become one of the owners of the Amazon company. But that requires you to have money in the first place. If you want to get money, then you're going to have to create a company. It doesn't mean you have to create the next Amazon, but you can create a side hustle. You can create a business. You can create a business idea. You can create something where now you're working to build this entity. And in the beginning, it's going to be all you. I've been there. You got to put in the work to grow it, to get it off the ground, to make your first dollar. It could take you 2 years to make your first dollar. But once you learn how to make your first dollar, now you can just keep repeating that to make your first $100. And you keep repeating that to make your first $1,000. And you keep repeating that to make your first $100,000. And you keep repeating that to make your first $1 million. And then you can just keep scaling and repeating what you're doing. But it takes time and the effort, and most importantly, the risk. And this is what holds so many people back. They see the risk. Oh man, if I start a business, I don't have an income. Versus if I have my job, I have the stability of my paycheck. If I have a business, I don't know what's going to happen. And so what you can do is start your business while you have that stability. Start it with the cushion. Once you're ready, then you can quit your job and work on your business full time, but you have to be willing to start. And everyone gets in that analysis paralysis where you're just like, oh, what happens if this goes wrong? What happens if this goes wrong? If you keep thinking about what's going to go wrong, well, then you're going to psych yourself out. Every business idea has issues. But once you start, you'll figure out how to solve those issues. Maybe you pivot. Maybe you start a new business idea. Maybe you realize this business idea sucked, but you're never going to know until you start. And this is where understanding that if you really want to achieve that level of wealth, you can't just do it by yourself. You're going to need more people. You're going to need more talent. You're going to need more brain power. But you're going to have to be able to rely on other people being productive to increase the amount of value that you put out. Because there's a limit to how much value we can put out. but there's no limit to how much value our entity can put out. And this is where now you have to understand that if you are willing to put in that work to grow that brand, now you can increase the amount of value that you're putting out, which can increase the amount of wealth that you achieve. Now, if you have a business idea, you also want to make sure that you protect it because, well, there's a lot of lawsuits out there of people trying to go after other people's business ideas, people trying to go after other people's names. I know when I started the Minority Mindset, someone tried to sue me claiming that they owned the name Minority Mindset. Luckily, I had already filed a trademark on the name Minority Mindset, so I was protected. But this is where you want to protect yourself, protect your brand, protect your idea. If you have a product idea, get a patent. And number 5 is just be focused with your time. This one is one of the simplest changes that everybody can do. Inc. magazine put out a study that the average American who is working 8 hours a day is actually only being productive for less than 3 hours a day. That means the rest of the time, the average American who is working an 8-hour a day is spending time on their phone, they're spending time on social media, they're talking to people, they're walking to the bathroom, they're doing random things where they're not actually working. If you want to get more done in your 24 hours, just get more stuff done when you're actually working. And there are so many simple hacks that you can use to help you do this. The first thing that I would recommend that I do is put your phone on Do Not Disturb. I keep my phone on Do Not Disturb all the time, especially when I'm working. I'll put it on full Do Not Disturb and I put it away from me. Second, when you're working, put your tab, whatever you're working on full screen. That way you're not bombarded with notifications. You don't accidentally want to go and check out Facebook. You don't want to accidentally check out what's happening on the news. You keep whatever you're working on full screen. Third, turn off the TV. Turn off the distractions. Keep yourself focused. When I was studying for the bar exam, I kind of took this to an extreme where I knew I hated studying. Studying, especially for the law bar exam, it was just such a burden on me. What I used to do was I used to go to the library. I didn't have an office back then. And I used to go to the corner back part of the library where there was this little seat in between 2 bookshelves. And it was in the back part of the library where nobody would ever go. It was completely quiet. And all you have is this little seat, this little bench, and then 2 bookshelves and a wall in front of you. It was almost like a box, like you're in prison. And that's where I would go to work. I would put my phone on Do Not Disturb, put it in my bag, that way it's not even near me, put up my books, so I have no technology, no distractions, and if I look up, all I see is a wall. If I look to the left, all I see is a wall. If I look to the right, all I see is a wall. If I look up, all I see is the ceiling. You're literally confined where all I could do was work. And I wanted to get out of this as fast as possible, so I would do my reading, do my practice exams, do my practice, whatever I had to do in that time, because I did not want to keep dozing off or doing whatever, because I wanted to get out of there. Force yourself to work. That was how I forced myself to work. Give yourself rewards. For me, it's food that I don't eat until I do something. That way now you're forcing yourself to do things. Because if you're constantly distracted, if you're constantly taking breaks, if you're constantly doing other things, now you're not being productive with your time. Now, you can take breaks. There's nothing wrong with taking breaks. You should take breaks, but just make sure you're taking breaks at the right time and you're earning those breaks. Earn whatever breaks, earn whatever rewards that you're putting out for yourself. Just earn it.
You're $500,000 a year, you can make a few $1 million and you can build millions of dollars worth of wealth and retire very financially free. But if you want to fly in private jets, if you want to have that very exotic lifestyle, you have to have way more money working for you. And the way that you can attract and accumulate that way more money is you're going to have to